about the external sector, global trade is expected to witness a slowdown in growth during 2026 as compared to 2025. This is due to the lingering tariff-related uncertainties, despite the Supreme Court judgment, ongoing conflict, 0.2%, ongoing West Asia conflict, and elevated energy prices. India's merchandise exports contracted by 0.2% during the first 2 months of this year on a year-on-year basis. This was a result of export contraction in key markets. Merchandise imports, on the other hand, recorded a double-digit growth of more than 22%. This is largely driven by higher gold imports. As a result, there was a widening of the trade deficit. Expected robustness in services exports and inward remittance receipts during Q4 last year, however, should keep India's current account deficit moderate and within the sustainable level last year. Rising global uncertainties and elevated prices of key energy commodities pose some upside risks to India's current account deficit this year. The recent bilateral and regional trade agreements with major trading partners are expected to boost India's trade and investment opportunities, while at the same time, they will also widen and diversify India's trading partners and integrate India into global value chains. On the external financing front, gross FDI witnessed a strong growth, almost about 20%. Net FDI also showed improvement on a small base of last year. India remains an attractive destination for greenfield FDI projects. FPI to India, driven by outflows, primarily in the equity segment, recorded net outflows of $16.5 billion last year. And even this year, till we have data till April 6, there were outflows of more than $5 billion. Flows under ECB and non-resident deposits too moderated as compared to last year. And as on April 3, for which we have data, latest data till April 3, India's foreign exchange reserves stood at a healthy $697.1 billion. These are adequate in terms of the standard metrics of reserve adequacy, whether one sees it from the perspective of import cover, we have about 11 months, as has been the case for some time, or whether one looks at it from the perspective of external debt. Overall, therefore, India's external sector indicators remain favorable. Nonetheless, elevated global geopolitical, trade, investment uncertainties require a continuous vigil of the evolving developments. Despite stronger macroeconomic fundamentals, the Indian rupee in the last financial year depreciated more than the average in the previous years. In this regard, let me reiterate, I've said it many times, our exchange rate policy remains unchanged. Specifically, intervention in the foreign exchange market is aimed at smoothing excessive and disruptive volatility without targeting any specific level or band of price for the exchange rate. This is consistent with our long-standing policy of exchange rates being market determined. And we in the RBI stand committed to this policy and would judiciously continue to contain excessive or disruptive volatility to ensure that self-fulfilling expectations do not exacerbate currency movements beyond what is warranted by fundamentals.